In April 2025, a single directive reverberated through the international financial system. A senior banking executive received an unambiguous order: cancel all pending loans to Chinese state-affiliated enterprises immediately. Within hours, approximately $78 billion in global financing evaporated, seemingly delivering a calculated blow to Beijing's access to foreign capital. This decisive move by Scott Bessent represented the most overt financial maneuver in America's escalating economic confrontation with China. But beneath this apparent tactical victory lies a more complex and potentially perilous reality. The very financial instruments being weaponized form the foundation of America's own economic stability. These aren't just loans to a strategic competitor. They're integral components of the intricate web supporting U.S. bond markets. As Washington pulls these threads, the fabric of its own financial architecture risks unraveling alongside its targets. The numbers reveal a precarious balancing act. China still holds $859 billion in U.S. Treasuries, according to Treasury Department data from March 2025. Despite Washington's increasingly aggressive trade restrictions, Beijing quietly increased its holdings by $18 billion in January alone. This occurs against the backdrop of U.S. national debt exceeding $36 trillion, with 10-year Treasury yields hovering at 4.5%, rates that already strain government finances and private borrowing. The question emerges: why would Bessent initiate such a high-risk maneuver unless privy to information that markets don't yet recognize? The timing suggests a calculated gamble, but one with potential domestic consequences that could eclipse any damage inflicted on Beijing. The roots of this financial vulnerability reach deeper than current policy decisions. In February 2025, President Trump unveiled a sweeping $9 trillion tax reform package that initially electrified Wall Street before triggering alarm bells throughout the financial sector. While the Congressional Budget Office projected an immediate economic boost, a 1.8% GDP increase for 2025, more sober analyses from Moody's Analytics warned of structural damage, potentially increasing annual federal deficits by $2.3 trillion and pushing America's debt-to-GDP ratio beyond 140% by 2028. The consequences have manifested rapidly. 30-year mortgage rates have surged past 8.1%, effectively freezing housing markets across the nation from Atlanta to Phoenix, according to National Association of Realtors data. More ominously, Fitch Ratings placed U.S. sovereign debt on negative watch, citing unsustainable fiscal trajectories accelerated by the tax cuts. Historical parallels offer little comfort. Reagan's 1981 Economic Recovery Tax Act similarly generated short-term growth, while dramatically expanding the federal deficit longer term. If this pattern repeats, the administration's strategy to financially outmaneuver China could collapse under its own fiscal weight before Beijing even responds. Early indicators suggest America's rivals are already positioning themselves for this potential outcome. Within the last 60 days, foreign central banks have divested an astonishing $256 billion in U.S. Treasuries, according to Federal Reserve Custody Holdings data. Japan slashed its exposure by $68 billion, bringing its portfolio of American debt to a 12-year low. Simultaneously, Saudi Arabia quietly reduced its holdings by $45 billion, according to Reuters reports. Analysts at Barclays have raised alarms about the disappearance of structural Treasury buyers precisely as Washington prepares to finance unprecedented deficits. The symbolism is unmistakable. Longtime allies that once underpinned America's fiscal dominance are now hedging against its potential decline. While Washington pursues financial containment, Beijing has methodically constructed alternative systems. In a telling development last March, The yuan surpassed the dollar as the most utilized currency for Chinese cross-border transactions, according to People's Bank of China data. This shift represents both a psychological and economic inflection point in the international monetary system. China has wasted no time exploiting emerging fractures in dollar dominance. Global purchases of Chinese government bonds surged 41% year-over-year in the first quarter of 2025, led by sovereign wealth funds from the Gulf states, ASEAN nations, and even segments of Europe, according to Standard Chartered's April 2025 analysis. The People's Bank of China now offers 5.88% yields on 10-year digital yuan bonds, outperforming US Treasuries without the accompanying inflation concerns. Ironically, Washington's strategy to financially isolate China has accelerated Beijing's emergence as a credible alternative destination for global capital. As Fitch's head of emerging markets research James McCormack observed last month, China is increasingly seen not just as a trade giant, but as a bond market safe haven in a world awash with American debt risk. If historical patterns hold true, that bond flows ultimately determine geopolitical gravity, America may already be losing a quieter, bloodless financial war. Beijing's most innovative counter-strategy emerged unexpectedly. Chinese development banks have begun issuing Chinese dollar bonds, debt instruments denominated in US dollars but governed entirely under Chinese law, according to detailed reporting by the Financial Times in April 2025. Over $127 billion of these instruments have been purchased by investors across Southeast Asia, the Gulf states, and even European pension funds, seeking dollar exposure without direct engagement with US Treasury markets. This maneuver brilliantly inverts traditional financial dynamics. Beijing effectively leverages global demand for dollars while simultaneously weakening Washington's control over dollar liquidity. HSBC's global fixed income strategist Mary-Therese Barton described it as a tectonic innovation, predicting that Chinese dollar bonds could erode traditional U.S. debt market dominance by approximately 15% within 3 years. The strategic implications are profound. If nations can maintain dollar assets without holding U.S. government debt, Washington's most powerful financial weapon, global dependence on Treasury bonds, transforms from a strategic asset into a potential liability. Despite public rhetoric supporting American sanctions, European financial institutions have significantly increased their exposure to Chinese markets. In the first quarter of 2025, European private banks expanded financing to Chinese projects by 28% according to Financial Times analysis. HSBC, BNP Paribas, and Deutsche Bank collectively underwrote over $43 billion in Chinese infrastructure and green energy bonds, providing capital that directly fuels China's next industrial expansion phase. As Credit Suisse strategist Zoltan Pozsar warned in March 2025, sanctions are a two-edged sword. They may punish, but they also redirect global capital where pressure is weakest. Beijing's revitalized Belt and Road Initiative, partially funded with Western capital, now encompasses 73 nations, expanding from 66 just 2 years prior. The contradiction is striking. America pressures allies to isolate China economically, yet financial pipelines from G7 nations continue building the very economic network Washington seeks to contain. Scott Bessent's strategy has reportedly expanded to include pressure on the Asian Development Bank, ADB, to freeze new lending to Chinese-affiliated projects, aiming to restrict Beijing's access to multilateral financing. The ADB, typically cautious in its lending decisions, had approved nearly $10 billion for China-linked ventures between 2021 and 2024, often with minimal public attention. This approach targets a critical funding channel, but also introduces systemic risks. The ADB's own 2025 governance report highlights a fundamental vulnerability. Cutting China off could fracture the institution's funding base, as Beijing remains its second-largest shareholder after Japan. Financial historian Lee Ahmed warned during a Brookings Institution panel in April that weaponizing multilateral institutions risks rapidly eroding their credibility and effectiveness. Washington's gambit extends beyond immediate financial calculations into existential questions about the future of international economic governance. Meanwhile, Beijing appears to have anticipated this move and prepared accordingly. The danger extends beyond Beijing's immediate financial responses to the structural vulnerabilities it has systematically identified and exploited. According to Bloomberg Intelligence, China has finalized bilateral lending frameworks with Saudi Arabia, Indonesia, and Brazil, totaling over $120 billion, operating entirely outside Western-dominated institutions. Simultaneously, Beijing has begun restricting exports of rare earth elements critical to semiconductor manufacturing and electric vehicle batteries. Following the Ministry of Commerce's March announcement that gallium and germanium export licenses would be severely limited for foreign buyers, markets braced for potential supply chain disruptions across high-technology sectors. Historian Niall Ferguson warned last month that the West mistook China's patience for passivity. Retaliation won't be loud, it'll be lethal and cumulative. If loan cancellations escalate, China's response could rapidly expand into critical materials, agricultural supply chains, and technology manufacturing, creating overnight supply shocks across multiple industries. Some analysts believe the United States has already passed a critical inflection point in this financial confrontation. Global direct investment into China increased 9.7% year-over-year in the first quarter of 2025, according to China's Ministry of Commerce, defying American decoupling efforts. Conversely, U.S. inbound foreign direct investment fell 14% according to Bureau of Economic Analysis data from March 2025. The yuan now accounts for 5.8% of global SWIFT payment transactions, as of March, double its share from early 2022. Mohammed El-Erian bluntly told Bloomberg Television, "Once a critical mass of global capital moves east, revering it isn't just difficult, it's structurally impossible." America's bond market remains dominant for now, but historical precedents suggest reserve currencies don't collapse suddenly. They erode gradually, transaction by transaction, bond by bond, decade by decade. If Beijing has successfully constructed even a semi-viable alternative financial network, the United States may already be fighting against fundamental economic gravity. Behind closed doors in Beijing, sources suggest an even more ambitious project is taking shape. A fully operational yuan-based global payment system backed not merely by government promises but by physical commodities, Saudi Arabian oil, Brazilian soybeans, Indonesian nickel, all priced in Beijing's new financial architecture rather than dollars. If successfully implemented, this system wouldn't just reshape global trade routes. It could permanently diminish America's financial leverage in international markets. The consequences would extend far beyond economics into geopolitical realignments with generational implications. Scott Bessent's directive to cancel Chinese loans represents not just a tactical financial maneuver, but a strategic gamble with America's economic future. As Washington weaponizes financial systems built over decades, it risks accelerating their obsolescence and hastening alternatives that diminish U.S. economic influence. The critical question remains unanswered. In the quest to constrain a rival's economic ascent, has America inadvertently accelerated changes to the global financial architecture that will ultimately diminish its own position? The coming months may provide a decisive answer, but by then, the financial frameworks that defined American economic power for generations may have already begun their irreversible transformation. While America focuses on winning tactical financial battles, China appears positioned to reshape the terrain on which future economic conflicts will be fought. History suggests that such structural advantages often prove more decisive than short-term tactical victories.